Welcome to Classic Value Investors. My name is Mariusz Skonieczny, and today I'm very excited to have with me Bill Fleckenstein from Fleckenstein Capital. Bill, thank you very much for joining me.
Thanks for having me.
Yeah, Bill, believe it or not, it's been 7 years since we talked last time, and obviously a lot of things have happened since then. We had a terrible bear market in gold. Uh, we had in quotes, fantastic economy. And now we're literally in a depression, and gold is moving up, and some people like yourself think that gold is going to go a lot higher. Um, can let's start with that.
Well, I think just to be clear, I don't know I don't know what the experience level of your entire listener base is, but there's nothing magical about gold. It's just something that is rare and has held its value and been recognized as a store of value for thousands of years. And so it's kind of special in that regard. Not many things have lasted that long and have been viewed favorably that long. And the cost on average to create an ounce of gold is probably somewhere between $1,000 and $1,200 on average. Some mines have lower prices and some have a little higher. So it's not like it sells at an astronomical premium to the cost of making an ounce. In any case, um, there are no good currencies because all the central banks, all the G7 central banks, certainly are pursuing the same policies, and many other countries have pegged their currencies to one of the G7 countries, mostly usually the dollar. So there's no good currencies. The bond market offers no value. The stock market may have some value, but it has a lot of risk, and so I think that gold is sort of uniquely positioned to benefit by the policies that are being pursued, both monetarily and fiscally. And and I think the way the lockdowns have been handled are kind of anti-business. And I think at the margin that gold would benefit from that because I think once the politicians and bureaucrats have realized that they can tell businesses what to do, i.e., what you can do and when you can do it, it's going to take quite a while to get them out of the businesses. And so all of these things, I think, work to create an environment in which gold can do well.
When I'm looking at exactly what you said, and I'm looking at the fundamentals of a lot of these businesses, they're pretty scary. Yet the valuations in the stock market are just probably higher than I've ever seen.
Well, listen, the reason the, the pandemic has what's created the depression. But the reason why the financial asset markets and um, sort of the plumbing, if you will, all the things that make the so-called shadow banking system. The reason why the Fed panics and did so much so quickly is because we've been having a financial bubble here in America for quite some time now, and you could argue that it's bonds and stocks, and so you had a bubble, which means it's sort of precarious as to how it ends. Um, got interrupted by not just some small event, a depression. So the combination of the two things ought to be pretty um, negative for stock prices, but they haven't been as negative as they would be because of all the things the central banks have done. You can look at, a lot of valuation measures, like stocks as a percentage of GDP in America, and they're at some of the highest levels that they've ever been at. So, while I think there are some stocks that are cheap, um, um, in the aggregate, the stock market is pretty expensive.
Yeah, in your previous interviews and your writings, you talk about the Fed losing control of the bond market. Um, can you talk a little bit about this and where you think they are in that process?
Well, by that what I mean is this: when the Fed started QE in '08, I knew that that would boost asset prices. I didn't know how long they would get away with it before there was a problem. Generally, if you just print money, you wind up with inflation. A lot of the inflation that we had went into stocks, high-end real estate, art, planes, things like that. In other words, the things that the top, you know, 1, 2, 3, 4, 5% wanted to buy. It didn't spill out into a lot of inflation for the average person. There was more inflation than is captured in the CPI statistics because they are uniquely calculated so as to not show any inflation when you look at the what substitution and hedonics do. So there wasn't as much inflation due to QE, and people were pretty confident about what it would lead to. I always maintained that they'd never be able to stop, ZERP and NERP and QE, and they tried for what 9 months or so, and then they had to start doing it again. So you can't consider these successful policies if you can never exit them. It's sort of like saying heroin's a good drug, but you're addicted to it. So these policies can't be stopped. They're failed, flawed policies, but yet it's the only thing they think they know. Um, so
Let me just ask you
eh,
something here.
no, no, wait. I want
Okay.
to get to your point though. I didn't because I didn't. And so my belief was that at some point the markets would stop them. You can't have the currency markets stop these reckless policies because the BOJ, all the central banks are doing the same thing after a fact. So at some point, I believe bond investors will say, wait a second, do I really want to accept 60 basis points for a 10-year piece of paper in America, or no basis points in Japan, when they're pursuing these policies? Here in America, we're going to get inflation. They're going to get it in maybe even Japan too. And so at some point, if the markets decide that the policies are bad, and they're not going to accept 60 basis points for a 10-year or whatever the rate is, then the bond market starts to back up. And then the Fed will fight that, and they'll try a yield curve control or something like that. But if the market wants to price interest rates from in a different place than what the Fed wants, and the Fed tries to get its own way, then they make the problem worse, and ultimately they lose control of the bond market. And that's the only thing that's going to stop them, is when they lose control of the bond market. Now the real question is, will they pursue cold fusion first? And Japan's the most likely candidate in that. But I don't want to finish that topic. I want to let you answer your question. Sorry.
Right. Okay. Um, when you were talking about they started the QE in 2008, 2009, and then at some point they wanted to tighten. And they were tightening. And I believe, correct me if I'm wrong, it was 2016 that they had to restart it, especially in the repo market.
No, no, the repo market just started last fall. But that's an interesting point. So what happened was, because of the way the dealers finance themselves and some of the ramifications of Dodd-Frank, the legislation that was passed after the '08 crisis, it turns out that the primary dealers didn't have the balance sheet to finance the treasury offerings. Said differently, there weren't enough buyers, ex the dealer community, for the market to clear at those rates. And so all of a sudden the dealers couldn't get financing, and so the Fed had to start a repo facility. In other words, the Fed's repo facility was created indirectly to finance the Treasury deficit, and that was in the last fall. That was before all this crazy stuff happened. So that was the first sign of them losing a little bit of control, but they kind of have it back right now.
Right, okay. So now they are doing QE at a level that we've never seen before. Um, and if it's so hard to stop the QE, I mean, how in the world are they going to reduce this, even if they
They're
try?
they're, they're never going to. They're never going to. They're never voluntarily going to. and it'll be up to the bond market sometime to discipline them. But you have a situation, let's look in Japan, where the Bank of Japan owns roughly half of all of the JGBs, and they also own something like 75% of the equity ETFs, a huge number. So, and there's a case where they've done all that and it hasn't really done much for the financial markets, unlike the mass speculation we have in America. But what if the Bank of Japan goes to the Ministry of Finance and says, look, you know what? Let's just tear up this paper that we own, or let's exchange all these bonds that we own for a 200-year bond, and you could pay us 1 basis point. Effectively, they would have wiped out over half the Japanese debt. Now, maybe they'll buy more and then they'll do it. Well, if they did that tomorrow, what would be the outcome? And if they do it, do the other central banks try to do it? So to me, the real question is, do they get to the place where they can pull off that so-called cold fusion where the central bank basically tears up the debt that it's purchased, or do the bond markets revolt first? I don't know the answer to that question, but the only thing that's going to stop these central banks in the end are the bond markets, because the currency market can't do it because they're all doing the same thing.
Right. On the topic of the currency markets, there was a lot of talk in the media, shortages of dollars and dollar going up. Can you talk a little bit about that?
Well, there is a school of thought that says if you borrow money, you're short dollars. I don't happen to agree with that thought process. It's not the same. As someone who ran a short fund for 13 years before I closed it down in early '09 because QE was coming and I gave the money back, I know what a short sale is. When you sell something short, it doesn't matter if it's a stock or what it is, you generally do it on an exchange, and there's a clearinghouse, and you have to put up a deposit, even though you are selling something short and getting proceeds. And that deposit has to be maintained at a certain level. And then if the market goes against you enough, they either force you to put more collateral, or you close out the position, or you're forced to close it out. But the point is, you can never walk away from a short sale. You have to make good on that. When you borrow money, that's not true. When you borrow money, you can default, you can renegotiate, you can restructure. So it's not, borrowing money is not a short sale. And the thrust of the dollar bull case is that all of these small countries or corporations in other countries and corporations in America, they've all borrowed dollars, and so therefore they're all quote unquote short dollars. And it's a fun little thing to think about. But the problem is the analogy is no good. It's not true. They're not short. They're not required to pay back the dollars that they've borrowed. I mean, they might, or they might not, and that's the difference. So that in essence is the bull case. I believe they are arguing their whole thought process is starting from a false premise, and even if they argue logically, they're ending up at a false conclusion.
Interesting. What you said about your short fund, yeah, I don't think I realized that you closed it in
Oh yeah, yeah.
2008.
I ran a short fund from '95 till 2008. When they started QE, I realized that it would make it very difficult to make money on the short side. So I decided that I didn't think it'd be profitable to be run a short fund. I didn't know how long it would not work, but I mean, I didn't think they'd last, 12 years, and and all that, and they'd do QE 1, 2, 3, and Operation Twist. But in any case, I closed the fund down and gave the money back because I didn't want to do battle with the central banks.
So for yourself right now, um, I mean, how do you how do you play the situation? Uh,
Well, for me, I'm invested in precious metals and mining companies.
do you
I mean,
mostly?
I dabble occasionally on the short side, but it just doesn't work because what the central bank's doing is so powerful. So it's, mostly I'll take a stab at a short now and again, but it hasn't really worked. So the thing that's worked has been owning the precious metals and the mining stocks.
Yeah. Well, in the past, the Fed would only buy the treasuries, and recently they started buying corporates, munis. I mean, are they even buying stocks? What is it that they don't buy right now?
But they don't buy stocks. They might down the road. They had to set up a special purpose investment vehicle and have the Treasury put some money in there. So the Treasury would take the losses on some of the junk and the commercial paper and the munis that they're buying. But they will, if they thought that, if things get bad enough or when things get bad enough, but they'd think nothing about buying stocks. They'd probably buy ETFs, but they would do it, just like the Bank of Japan.
Right, right, right. Interesting. So when it comes to gold and gold stocks, do you, what kind of, without individual names, but what type of gold stocks do you focus on? Do you go for the big ones, or do you like to maybe look at some juniors? Where do you stand on that?
Well, I kind of have a collection of all of the above. Um, um, for instance, the mining companies that I have tried to own companies that have most of their assets in North America, or at least the countries in South America, Central America, where there have favorable mining jurisdictions and there's some sort of rule of law that you can count on. But North America is the best place. Peru has been a pretty good place to be. Chile's been a pretty good place to be. Brazil, Mexico, depending on where you are. Now, in the wake of this coronavirus problem and what it's done to their economies, some of them may be, a little less friendly to the miners prospectively and try to take a little, figure out a way to claw some more money out of them than they have in the past. I don't know. But I'm a little worried about that. And some of the other countries are, a lot of the other countries are worse. There's some that are okay, but I don't want to own any assets in Africa or any places where I think the government might do something semi-unilateral. So I think it's important, and you can find plenty of good companies. For the most part, I've owned bigger ones that have higher grades, but now some of the lower grade ones might be able to do okay. And I probably have my split is probably something on the order of 80 or 85% of what I have is in bigger, either large or intermediate size, and maybe, just 10% in some of the speculative development junior kind of names.
Okay. Do you see? Okay, because from 2011 to probably 2016, very few people wanted to touch gold, and now I hear more from generalists that gold might not be a bad place. Do you see more generalists getting interested in gold, or do you still see it mostly, among the people like yourself who understand the the Federal Reserve and how the money printing is going to affect the value of currencies?
I think that since the Fed print fest that began in March, I think there's more interest in the sector than there has been for quite some time. We will know better, say in July and August, when we can look at the 13 Fs of the big investment firms, institutions, and see what kind of money they've put to work in the area. You can see the gold ETF taken down lots of ounces. So surely people are buying gold. And in the mining entities, they trade differently than they have for the last several years. And I can only assume that means that people are getting interested. I mean, for the longest time, nobody wanted gold, and they certainly didn't want the guys that produced gold. And now people maybe have realized that, hey, we want to own gold or silver, and we can buy these companies that produce that stuff. And oh, by the way, they're making good money, they're paying dividends, they got good balance sheets, good growth. And so the attitude towards the sector is shifting, but it's very early days, I think.
Okay. Uh, when this coronavirus lockdown took over the world, some refineries closed, and there was a lot of talk about people buying physical gold, but they couldn't get deliveries or they had to wait. Um, Now, do you have any view on, I mean, are there physical shortages or this was just something that made headlines?
Well, that's a really good question. I don't think we know for sure. I think it might be a little bit of both. So I think it goes like this. There was sort of a viewpoint that that the London gold vaults basically held, an unlimited supply of gold that could be utilized and brought into the market at any time. And I think what we saw was that supply and demand was more finely balanced than people maybe had appreciated. Because when we had the virus hit and countries closed down mining, all of a sudden mine supply to the market was disturbed. Refining supply was disturbed, transportation was disturbed, and we had this situation where the COMEX front month blew out to over $100 premium to spot. And I think the reason for that was that there was just not quite enough metal at the right moment in time to be able, and also transportation is just to be able to facilitate certain amounts of arbitrage. But more importantly, I think it shows the market was more finely balanced than people believed, and that there isn't an more or less unlimited supply of gold that can be marshaled at any time, and therefore I think people are more inclined to see that the the potential or the prospects for gold to go much higher are a little more readily apparent than they were before.
Yeah, interesting. Okay. And also what I'm hearing is that gold is at what, like 1740, 1750 right now?
Yeah.
And the Fed's balance sheet is growing at a faster rate than ever before. The money printing is highest that's ever been. So I'm hearing some people say, well, why isn't gold over 2000? If gold cannot go over 2000 in this environment, how can it ever go?
Well, that presupposes that the person asking the question knows exactly how the linkages for every policy and everyone's thought process is supposed to be. So, I would say, well, it's gonna do what it's gonna do when it's gonna do it. I mean, it's sort of an arrogant thing to say, well, the market hasn't done this yet and it should have, therefore it's not going to. Well, maybe that's true and maybe it's not true. Nobody knows. So I don't know. I mean, it's like silver. I understand the silver market pretty well. I was the director of one of the largest silver companies, Pan American Silver, for a long time. And recently, I kind of get a chuckle out of people. This gold silver ratio got blown out to a ridiculous level, and people said, "Well, silver can never grow up. It's a industrial product. It's not a precious metal." And I just had to laugh because they say that every cycle. And then all of a sudden, silver wants to go, it goes. And so lately, it kind of picked up its head. It was up like 5% on Friday. It's going to go from being a $16 ticket to a high 20s in some short space of time somewhere along the way, and people will be scratching their heads and say, why'd that happen? Well, it was just finally time. And the same thing, one day, one period, all of a sudden gold will go nuts, and people will say, well, why is it going nuts? And it's just that it's that moment in time. So I don't really think much of those arguments that say it should be much higher. Therefore, since it isn't, it means it's not going to ever be higher. I just don't buy that argument.
Right. Uh, just 6 weeks ago or something, I know people were getting very frustrated with the miners. Why aren't they moving? Why aren't they moving? And then all of a sudden they did move.
Exactly. That's the exact point I was just trying to make. Thanks.
Yeah, yeah. Okay, and then in the final question, okay, so it looks like the lockdowns, they're trying to, reopen businesses. I know you're in Seattle, and I think Washington got hit pretty hard, at least at the beginning. How are things looking there, where you live?
Well, every state and almost city are different, and I am quite worried that once you let politicians and bureaucrats start telling businesses what they can do, it's liable to lead to big trouble because there's going to be a second wave of the virus and they're liable to overreact. So, we're slowly talking about opening things up slowly but surely. I think that they've handled this route, poorly. I think we need to be more aggressive about getting businesses back to work because people have to have jobs, and there's a lot of consequences of people not being able to make money for 3 months. And now they want to talk about maybe a couple more. I mean, you can ruin lives and families and all kinds of stuff. I mean, we're not going to, as someone recently said, we've gone from flatten the curve to find a cure. I mean, that's ridiculous. That's absolutely ridiculous. So I think it's going to be a huge problem to get things back to anything close to normal, even if people are willing to do that, because you're going to have the politicians involved, and some are too stupid to make business decisions, and the others are too sleazy, and they're going to do things that are in the best interest of their political agenda, not what's in the best interest of the people that they are presiding over. So I'm concerned that how all this plays out. I'm worried that it won't go well. I mean, I would like to see people be able to get their jobs back and start making money again. This is horrible what we've done to all these people.
It is, and let me just give you an example of myself.
Okay.
A lot of people that know me online think of me as an investor, but really most of my money or the money that I make to pay my bills, I teach ballroom dancing.
Oh, no kidding.
Yeah,
No
yeah, I'm a
kidding.
yeah,
Okay.
yeah. So I teach private lessons, and before this coronavirus happened, I I would say I taught about 15 lessons per week, and my lessons are down 90% because
Yeah.
of that. And we're talking about one-on-one lessons. We're not talking about being in a group of people. It's just me and you. And
Right.
people still are afraid to come. And some of them are not coming because they're afraid, and some of them are not coming because they lost their jobs and they can't afford lessons. So, but to me personally, I'm down, 90% of my income. And thank God that I'm, re- I'm I'm responsible and I have savings and I also make some money by selling books. I'm able to pay my bills. But if I didn't have savings, if I didn't have my books, I don't know how I would pay my bills.
Right. I mean, it's just devastating.
Right. And now we're talking about opening the economy, and I'm thinking, okay, how are these restaurants are going to do? Who's going to go to a restaurant in huge numbers? And even if they do, the politicians are probably going to make them have less tables or something to make those businesses uh, much less profitable than they were before, even if they could get all these people back.
Yeah, I don't know. I mean, it's just like, I mean, again, the politicians are going to make it so that there's no profitability for these poor people that run restaurants. I don't know how it's going to work. I mean, they ought to just and the idea that I mean, the idea that the government hasn't already said, hey, nobody can sue a business if they get coronavirus going there. I mean, why should you be able to sue somebody if you get sick? I mean, that's insane.
Right.
Why should the businesses have to worry about that on top of everything else? Hey, people get sick all the time. You can't, it's just ridiculous.
Yeah.
I mean, it just, again, it's because the politicians were able to effectively get control of the businesses, and now they can make up any kind of stupid rules they want.
Yeah, that's right. Okay, Bill. Uh, Thank you very much for agreeing to do this interview. Maybe next time we're not gonna wait 7 years to do another one.
I
Uh,
can't believe it's been that long. I thought it might have just been a couple.
no, it's yeah. I looked at our last video and it was 7 years ago. So,
Wow.
but
Wow.
I continue to follow you and listen to your interviews and wisdom. So I really appreciate your insights over the years.
All right. Well, thanks for asking me good questions.
Thank you. Have a good day.
All right. See ya.